All right, so let's go ahead and do some projections for Sahali for the next year. So here's how we're going to do it. And remember, our big question account is cash. That's what we're going to solve for at the end of the day on the balance sheet. So first, we will compute our PPE roll forward, income statement, and equity roll forward account statements and equations. And then on the balance sheet, we'll be able to put in the equity value from the roll forward and a couple other things here and there from other places. But the key thing is the equity value from the equity roll forward. And then we're going to calculate all the other balance sheet items except for cash. Cash is the big deal on the balance sheet that we're solving for. And then we're going to balance the balance sheet. What do we mean by balance the balance sheet? Balance means that assets equal liabilities plus equity. When that is true, you have a balanced balance sheet. And we're going to do that by breaking assets into cash plus all other assets equal liabilities plus equity, and we'll solve that for cash. So let's get to it here. So now I've got my roll forward. So here's the most recent year for our roll forward equation. And I've got how specifically we're projecting each piece. And then over here, I'm going to have my value projected for the next year, 20x1. So let's see how that works. Okay, I'm starting off with my PPE net at the beginning of the period. And you may remember that the PPE at the end of last year was 100. So you see how I take that 100 from last year and blammo, bring it over there. And that's exactly what I've got stated here in our how do we project it, right? We're projecting it as last year's end of year PPE. Okay. All right. So that's jumping ahead a little bit down here at the bottom. So I'm going to hold off on that. Okay. Next up is depreciation. And last year it was about 9 million, but we know that from the CFO, we've been told that should be about 10% of beginning of period net PPE. So in most circles, 10% of 100 is 10. So that's how I got 10. All right. And then the CapEx that's the one thing we don't know. She hasn't told us anything. We don't have anything else for it. But happily, this is an equation, and we know everything in this equation except for CapEx, so we can solve for that. All right. And PPE at the end of the period, we have that dictate from the CFO that she's saying that they aim to have the PPE at the end of the period equal to 100% of TTM sales, and TTM, if sales are growing at 10%, which she also dictated, right, then we're going to be at 110 for that. Okay, next up, we do our income statement for sales. She said grow by 10%. Here's our 110. And then for COGS, remember we had nothing for COGS. We had no dictate. We had no equation. So we say if COGS was 68% of sales in 20x0, it's going to be 68% of sales in 20x1, right? So how do we get our 74.80? 74.8 is equal to the sales in the year times 68%. Incredible. Okay. So that's how we got that 74.8. And for depreciation, we have our roll forward equation, and we've already got on that. Here's our roll forward. Here's our depreciation of 10. So we just pull it off of there. Pretty cool. Okay. And then for SGA, we know there was nothing for SGA, so we have to go as percent of sales. So in year 20x0, SGA was 10% of the sales. That's how we got this 10%. 10% of 110 is, in most circles, 11. And we subtract all that, we get our EBIT, and then we go through with the interest is going to be 7.25% times our beginning of period debt. And we know that from here's our debt in the prior year, end of prior year is beginning of current year. So that's going to be 7.25% times 20 there. And let's go ahead and do that. let's put a star down here and say 1.45 is equal to 7.25% times 20. Okay, and once again, as usual, let's just throw it over into the electric pencil, convince you that indeed and in fact this is the truth, the whole truth, and nothing but the truth. All right. All right, 1.45. So there we go with that. And the tax is 33% of EBT. EBT is 14.21 minus 1.45. Take 33% of that, and you get 4.21. And then we can get our net income of 8.54. So that's going to help us when we go ahead and do our equity roll forward on the next page. So that tells us that equity beginning of period plus net income minus dividends plus paid in capital equals equity end of period. Okay, so the equity end of period here was, in this year, 20x0, it was 80. So that's going to be the beginning, the start point for the next year. All right, and we've got here net income. We just saw on this income statement projection, the net income projected for the next year is 8.54. So we just take that. And the dividend, that comes from the board, right? They're saying we want a 15% payout ratio, dividends equal to 15% of net income. So that'll be 1.28 million. All right. And the board says no changes to paid in capital. And now we know all of these numbers. We know everything except for equity end of period, but we know that 80 plus 8.54 minus 1.28 plus 0 equals, it's really true, 87.27. Maybe plus or minus a little bit for rounding error. Okay. And now we're ready to do the last thing, and that's the balance sheet. And the balance sheet, I'm not going to go account by account because it works exactly the same way it did for the other accounts. So first you leave this blank, right? And then you go through and fill in all the rest of the numbers. We know how they all work, okay? And then to get that 2.77, we're going to say cash is equal to what here? Our liabilities, total liabilities, plus equity, minus all other assets. All right, looking good here. So let's just compute some of the quantities that we haven't computed already. For COGS, we actually looked at that. So, but anyway, I'll just put it in for us again. So it's 68% times 110. And let's note that 20x1 sales are equal to 110. Okay, and then we get 4.8. All right, and depreciation was equal to 10% of beginning of period net PPE. So that was 10% times 100. And that worked out to be 10. And inventory was a percent of sales number. And it was, let's go back to the balance sheet here. We said it's going to be 35% of sales. Why? Because in 20x0, it was 35% of sales. Remember, sales in 20x0 were 100. So 35 over 100, 35%. And that ratio is going to stay the same in 20x1. So the value for inventory is going to be 35% times 110. And that's equal to 38.5. Okay. And equity, we've already looked at here. So let's see the roll forward, because that's really illustrated perfectly on the roll forward. And now let's see how we were able to solve for cash. So we're going to take this assets, that's total assets, equals liabilities plus equity, right? And assets are equal to cash plus all other assets. So we have to add up all other assets from the balance sheet here. So we're going to take accounts receivable, inventory, and PPE net, and that's all the other assets. So let's go ahead and get that first of all. And so that's equal to 176. And let me show you how I got 176. So it's equal to 27.5 plus 38.5. Okay, 27.5 plus 38.5 plus, I've got to get my PPE net in there. And where's my beautiful PPE net? 1110. Okay. Plus 1110. And that's equal to 176. All right. So now my cash is equal to liabilities plus equity minus 176. So let me get my total liabilities here, 91.5. 91.5 plus the total equity is, here we go, 87.27, 87.27. Okay, and then we have to subtract our all other assets, 176, and if you work that out, you get to, 2.77, and that's going to be plus minus a bit for rounding error. That's because all of these things were done in Excel, and even though Excel is formatted to only show us 2 decimal places, Excel is working to 14 significant figures, right, which is going to be about 12 decimal places. So there's a little bit of a difference if we use the numbers that we see versus the actual numbers that Excel is using, which are a little more accurate. Okay, so that's pretty great. Then let's get to the things that the CFO was asking for. She was asking for general ratio analysis. So here's the ratio analysis from the historical statements, and here's the ratio analysis from the new statements. Sales have grown from 100 to 110, or 10%. Excuse me. Profit margin is just about the same. And the debt to capital, debt over debt plus equity, has gone down a little bit. The current ratio, this is a little troubling. Okay, that's current assets over current liabilities. That's a little less than 1, so that's maybe not so great. Fixed coverage ratio is still very, very good, so that's great. And the cash percent of sales has gone down from 5% to 2.5%. Okay, and now we are ready to report back to the CFO. We say we've done a general ratio analysis for you, and here are the key results for you. You wanted to know where the cash would be at the end of next year. It'll be about $2.77 million, and the cash level she was concerned about, remember, she likes that to be at 5% or more. That's the cash at the end of the period divided by the sales in the current year. So that's a lot less than she wants, right? She wants 5, it's down to 2.5. And she also said, what's the amount of dividends that we're going to have to give out? And that's 1.28 million is the amount of dividends they'll give to the shareholders. So as usual, as awesome Miami students, we're not going to leave it at this. We're going to anticipate that since this is less than she wants, she's going to say, how could we do what the board wants and still have a safe cash level? So we want to think about that and be ready to answer that for her. So we go something like this when we meet with her. I just gave you all the information that you look for, and you'll notice the company can run profitably, safely for next year, except that the company is going to be breaking your safe cash level policy. And we recommend that you can get over this problem by taking out a revolving loan that will ensure a safe level of liquidity. A revolving loan works just like a credit card does for us mere mortal individuals. So for a company, a revolving loan is like the mother of all credit cards, right? They have an agreement with the bank that they can get money from the bank whenever they want. And whenever they get money from the bank, that's a loan, same way it is on a credit card if you don't pay it off every month, and they'll have to pay interest on that. So that's what a revolving loan is. They're fairly common. So that way, even though there wouldn't be 5% of sales of cash on the balance sheet, there's that ready instantaneous loan they could take out at any time if their cash got very low, got way too low. Okay. And so that would be my suggestion. You might have different suggestions for her, one of which might be go back to the board and tell them they can't do it. That's probably a bad idea. But there are other things that you can think of that would be great. And on that note, that pretty much covers everything with pro forma projections. So I hope that this has been clear and informative for you, and I'll look forward to seeing you again soon. Take care.